How are you approaching China?
Yeah, so we're cautiously optimistic. We know China has a lot of problems. They're in the middle of a property deflation. It's very hard to get out of deflation. Property assets, the biggest asset of a Chinese consumer for us. It's much more important than tariffs outside an extreme scenario on tariffs. So when the property market bottoms, you can really add risk. But we've been adding risk in China. We think the market bottomed last year. We're in a bottoming process now. They're doing more fiscal and monetary. Of course, they're going to wait to do more fiscal to wait to see what happens on tariffs overall. So that could be come out over the year. But there are areas that are performing within the China market.
But would you share the view of many in the market that Beijing is still tinkering around the margins in terms of the stimulus response, and we need to see bolder action, particularly aimed at restoring consumer confidence?
Yes, so property is key. Fiscal deficits will go up this year, 8-9% of GDP. But we need to do more. I mean, the best would be create a bad bank. The issue is liquidity. Segregate those loans a la GFC, and then you have confidence to lend to developers who have clean balance sheets and the banks have balance sheets. That hasn't happened yet. That would be the ultimate bull signal for the market. But we do think they're doing enough to put a floor on the market. That's the thing, and within that, there's value.
How vulnerable is China to the tariff threat from the United States? Because at this point, it seems to be relatively calibrated. 10% may be a negotiating tactic. There could be upside risk to that. There could be escalation to that. And now we have DeepSeek, which muddies the waters even further in terms of the response.
Yeah, I think tariffs are going to go higher. It's just a question of how much. We think it will be incremental. What's interesting is China's, if you look at imports into the U.S. from China, they've gone from 21 to 13%. So it's a different world than Trump 1.0. And China's trading more with ASEAN and other parts of the world. At the same time, we know the China plus one countries, say like Vietnam, they're exporting much, and some of that's re-export. So I think there's actually risk for some of the China plus one countries because they're running huge trade surplus because some of it's been outsourced from China to, for example, to Vietnam. So that's also a risk, and that's why there's a focus on Canada and Mexico as well as beneficiaries, and of course, big traders with the U.S. So that's the first thing. I'd say the second thing is with China, the key is what you already prefaced, property market. To us, when that bottoms, consumer spending bottoms, and you actually get confidence in the broader economy. The irony is the more tariffs we get, the more stimulus we'll get. So I think that's the quid pro quo when we think about how it applies to China. But overall, it's less dependent than the previous trade fiascos in the past. But 60% all at once would be destabilizing, not our base case.